Well, howdy there, folks. Welcome into today's video. Boy, do we have a lot to get into in this one here today. I have some shocking things to show you in regards to the market, sentiment around the market, and how fast it has switched. I can't wait to show you guys that in this video. A lot of stocks to talk about. Some big stocks moves, made some big downward moves, including Adobe stock. Adobe stock made a massive move down today, right? Adobe's such a great company, getting close to 52-week lows again, right? Another day or two like it had today, and it'll be back at 52-week lows. So we're going to speak about that one, if that's a buying opportunity. A lot of stocks, a lot of things going on in the market. I appreciate everybody joining me as always for these videos. Thanks so much, guys. Thank you, everybody. Subscribe to the channel. Everybody in the Patreon squad, I posted up the new stocks I bought in there here today. I posted it up maybe 2-3 hours ago, and 2 are growth stocks. One is a value stock I bought here today. If you're looking to access the stocks I'm buying and selling each week, check out the description area. That will be to sign up for the Patreon. It's $10 a month, and you get access to see the moves I'm making in there and get to support the channel. I appreciate everybody joining me as always. Okay, so yesterday, if you saw yesterday's video, right, I talked about the big decision that I had on my hands in regards to basically funneling Google money into Amazon stock, and I did go ahead and make that decision here today. Okay, I'm not going to go back through all the reasoning behind that. If you want the reasoning behind that, check out yesterday's video that went super in depth on why I believe, Amazon just has a better risk reward profile over the next 3 to 5 years than Google. Over the next 3 to 5 weeks, over the next 3 to 5 months, I have no clue. Okay, who knows? Maybe Amazon stock will outperform Google. Maybe Google will outperform Amazon. I'm always thinking about it for the next 3 to 5 years, and I definitely think Amazon's going to significantly outperform Google for the reasons I spoke about yesterday. Okay, so it was a very tough decision. These are the toughest decisions for me, and I think anybody that's a long-term investor is trying to figure out sometimes, do you have money in a stock that honestly you should have more money in another stock, right? And you always got to stay diversified in the market. I probably own 25 different stocks or so in the market, right? So I own a significant amount of different stocks, but sometimes you got to figure out, like, should I really be positioned here or should I be positioned there? And those are tough decisions because Google's at a very fair valuation right now. But obviously, I don't even want to start diving into that one. I did that yesterday. So once again, if you want to just hear my opinion on Google, you can check out yesterday's video on why I feel like Amazon's a better risk reward for this next 5 years than Google McDougal. Okay, so obviously, the market down big today. Nasdaq down about 1.7%. S&P 500 down 1%. Google McDougal. Dow down over 300 points. Russell down as well. Whenever I see a Nasdaq down, getting close to 2%, I always just automatically assume like everything's going to be Red Dead Redemption in my account, but it honestly wasn't. That was a strange thing. I'll show you that in just a moment. Now check this out, folks. This is getting intriguing now at this point in time. We're only 1,000 points away from, the NASDAQ hitting a new low, right? Now, if that happens, we'll have to see, okay? We'll have to see about that. I could say I'm hoping for that to happen, and this is one of the rare times that I feel like longs and shorts all want the market to go lower, okay? And we'd all love it to hit new lows. The shorts are desperate at this point in time. They're being absolutely obliterated. Their put options have been expiring worthless, right? Their short positions have been absolutely wrecked. Absolutely wrecked for the last couple of months. So they're obviously very, very desperate for this market to go down. But then also longs like myself and many of you guys, we want the market to go lower as well, because obviously it's just better deals for us in the end, right? More stocks that we can buy for a cheaper price, like call us in, coach, like we're ready to buy, right? And nonetheless, it's one of those rare times where you get shorts and longs all saying, let's hope this market goes lower, baby. Let's get it back down there. Let's get it down another 1,000 points in the NASDAQ. Let's hit some new low or something like that. I think it's going to be tough sledding. It's a possibility to get it there. And we'll speak about that a little later on in the video. A lot of that has to do with inflation, some of the worries around that, the Fed, things like that. But all I can say is I'm hoping that happens, okay? And hey, at least if that happens, maybe the shorts can have a little bit of money so you guys can go long or something like that, because y'all been in some trouble. Now, interesting thing happened here today, okay, is there was a lot of stocks I had that were green today. Very surprising. And a lot of stocks that just didn't even go down as much as the market. Palantir didn't go down that much. Meta hardly went down. Skyworks hardly went down. Elf on a Shelf hardly went down. Wynn hardly went down. Foot Locker was green. Fubo was green. Target was green. JP Morgan was green. I do own some SH in one of my portfolios, which is basically just short S&P, so of course that's green today. Chef somehow was green. SDOW was green, which is basically a 3x leverage against the Dow. That one was obviously very green today, right? Avant was green here today, and Revolve was green here today. Now, by the way, Avant, I just got to tell you guys, this is shocking, okay? we could have lost one of the CEOs of one of my companies. Like literally could have lost his life. Like pretty crazy situation. That is my smallest cap company I personally own, right? It's a small MJ player out of Canada. They actually have earnings coming up here in a few days. But it's crazy, man. He was in a really, really serious car accident, actually. So it just shows you never know in life, man. You never know when it could be your time, right? Thank goodness he's fine and those sorts of things, and hopefully whoever else was on the other situation was fine as well. It looks like kind of like a head-on collision, which is arguably the most dangerous accident you could possibly get into. So yeah, he was in a G-Wagon, I guess, in that situation. So from my understanding, he's fine, and thank goodness around that, man, because especially with the smaller cap companies, like they're very dependent upon whoever's the CEO of the company, because those are really the guys driving those businesses. It's not like some big conglomerate that it's like you could just plug and play a next guy. So yeah, glad for his life he's okay, and for his family and all those sorts of things. And yeah, crazy situation. Okay, now obviously we have a problem on our hands, folks. We have a problem, and it's a significant one. PCE came out today, and it is worse than expected. It's worse than everybody expected, right? And basically, as far as PCE changed month over month, or excuse me, month versus 1 year ago, it went up, okay? It went up, and that's something no one wants to see right now. There's so many inflationary worries. No one wants to see this. No, to make matters even worse in this situation, we have to wait like forever, or what seems like forever, till the next report, right? We don't get the next report till March 31st. That's like 100 years from now, man. And in stock market days, it's like, oh my gosh. So now we got to sit on this bad number for another over a month from now, right? And just look at that, and the worry is that inflation's going back up again, or, I mean, obviously it's still going up, right? But in terms of the rate of increase could get more substantial. It just bleeds into all these worries about inflation being sticky, all those sorts of things, right? And if we look at core PCE, right, which is maybe the Fed's most, let's call it, important metric they look at, right? It's always a debate if it's PC, core PC, or if it's CPI, right? But this is supposed to be arguably their most important they look at. It went up as well, right, from 4.6. So we had been on a nice trend, 5.1, 4.8, 4.6 is exactly what you want to see. So this month you would have wanted to see a 4.4, a 4.3, and instead we got a 4.7. Okay, no one wants to see that right now, and obviously we got to sit on these numbers for quite some time. No one wants to do that, and now the worry is, inflation is going to continue to be here, it's going to continue to be sticky, and everybody's kind of going to go to that sort of mentality here, at least in the short term, that is, okay? And the reason this causes such significant problems is now it's going to look more and more probable that Jay Powell and the Fed's going to raise 50 basis points next time they raise. The thought process was, okay, they'll raise 25 basis points, and maybe they'll do another 25 basis point move this year, and then they'll be done. But now the thought process is they're going to do 50 basis points for the next raise, right? And maybe another 50 after that, and maybe another 50 after that, right? So everybody kind of runs to these extremes in a volatile time period, right? And after we got burned with inflation last year, a lot of people are just going to run to the worst case scenario. And so now they're just going to start assuming we're going to get a bunch of 50s and 50s and 50s for this entire year, right? If you're talking about the difference between a 25 basis point move and a 50 basis point move for this next, let's call it, move they make, it's not substantial at all, especially when your rates are already approaching 5%. Like, that's nothing. But the bottom line is, in this situation, everybody's running to the conclusion that this is going to be a trend, that the Fed keeps moving 50 basis points and keeps rates higher for longer. And that's a fear, obviously, for the market. It's a fear for what can happen in the economy and those sorts of things as well, right? So that's a thought process. That's why it's an issue. That's why you obviously saw the market down today. Everybody wants to see these numbers coming better and better and better month over month, and just, a trend continue there, and it just is not happening, right? Now, something interesting kind of play out here now, okay? Because you're already starting to see some political pressure on the Fed, right? And, Elizabeth Warren, obviously somebody that's pretty known in the political field. It's not like she's a no-name. A lot of people, you say Elizabeth Warren, if you know anything about politics in the United States of America, you know who that is, okay? And, she was just saying recently, not that long ago, we want to bring down inflation, but that means landing the plane, not crashing it. Chair Powell should pause his interest rate hikes and remember his dual mandate, fight inflation without throwing millions out of work, right? And here's the thing with what Elizabeth Warren said there, okay? What she said there carries absolutely no weight at the moment. And the reason it carries no weight at the moment is, and why Jay Powell and the Fed don't even listen to that right now, is because unemployment is pretty much the lowest we've ever seen. So the Fed is not worried about the economy right now. The Fed's not worried about unemployment or jobs or anything of that right now. They're just not. They're only worried about inflation, and that number's just ticked up. And so is it, now they might move 50 basis points next time. We'll see what happens. But that's why her statement there carries no weight. Now, we know the Fed in the past has bowed to political pressure, right? But that was a different political pressure, right? In that situation, Trump, this is in late 2018, came out against the Fed, and the Fed ended up moving the way he wanted them to move. Basically, the Fed was starting to raise rates in 2018. Trump didn't like it. Market started to tank. Obviously, the economy started to look a little shakier, and Trump came out and he spoke, basically told Powell what to do, and the Fed ended up doing it. Whether they were influenced by Trump or not, we'll never know. But there definitely could have been some pressure there. But I can tell you, when Trump came after them, it carried more weight. One, because he's the president of the United States versus obviously Elizabeth Warren's not, right? But the second part of that is, there was a lot of worries about the economy potentially being hurt, and you weren't getting record, low unemployment at that particular time. So that carried some weight. But at the end of the day, as soon as we get any uptick in unemployment, believe me, Biden, obviously most of the Democrats, they're all going to come out heavy against Jay Powell to start lowering rates. And he will cave. I can promise you that. He will 100% cave when that political pressure goes on. It's just right now, they don't carry any weight. If anybody from that side wants to put any political pressure on the Fed to stop raising rates or lower rates, they don't have anything to go off of right now. Unemployment's way too low. If you also start to come in and you start to see major job losses, that changes everything. That's the moment when all of a sudden massive political pressure comes on the Fed, and next thing you know, they have to stop raising rates or they'll start cutting rates. And you say, well, the Fed shouldn't be influenced by politicians. Yeah, there's a point in time when it does happen, and it does carry weight. And that could happen maybe this spring, maybe this summer, but we'd have to see some sort of uptick in the unemployment rate, job losses, something that's concerning for the economy. And then all of a sudden the Fed will flip at that moment, okay? Now, Adobe stock made a big downward move here today, 7.3%. That's a substantial move. It wasn't like they came out with earnings or something like that. And basically what's going on here is the DOJ, the Department of Justice, is going to potentially block their deal for Figma, okay? Couple things in regards to Adobe, okay? First off, great business model, going to continue to be here, going to continue to be a cash flow and profit machine. At a very fair forward PE right now, it's actually a buy. But that doesn't mean it can't go lower here in the short term. If they're not allowed to do this Figma deal, it's substantial. It was supposed to be a $20 billion deal. It was supposed to be for the future of Adobe. And it just kind of solidifies their next 20 years, okay, of just success. They paid a hefty price for that. If the deal does go through, $20 billion is substantial, especially given what Figma's current revenues are. But like I said, it's kind of like the safety net for Adobe for the next 20 years. So if this deal doesn't go through, it does matter for Adobe. It's not great. But at the same time, if it doesn't go through, and let's say that the government blocks this deal from going through, Adobe's going to have a whole ton of money on their hands. That money can be used for other acquisitions if they want to make another deal out there. It can be used on R&D to build maybe competing products to Figma or something else that they have up their sleeve. It can be used for share buybacks. As of today, Adobe is about a $146 billion company. So if they want to use $20 billion for a buyback, that would be insane, right? So there's many different options for Adobe here in this situation. And like I said, their major business model is still phenomenal. So it's not like that's going away or something like that, right? So nonetheless, this deal, if it doesn't go through, it matters for Adobe, but it's not like the company's done. Like, oh, Figma couldn't go through, so we're finished. The stock's finished. It's not how this works at all. And actually, the interesting thing is Figma was going to be a drag on their net income and earnings per share for the next couple years if that did go through. And so if that doesn't go through, then it's not a drag, right? So there's pros and their cons with each of this situation in regards to Figma. My hope is everybody gets really depressed about a Figma deal potentially not going through and the Department of Justice blocking this and creating some sort of problem with Adobe where that stock goes in the 200s again. I'd love to pick it up, just add it as a long-term investment play there. And, sometimes you just have to step in with great companies when there's these sorts of issues. Sometimes you just have to step in and take advantage of the deals you're getting in that certain time period, even though there's uncertainty around if that deal will go through or not, okay? I would call it about a 50-50. I've looked at the deal. I've thought about it from Adobe's perspective. I thought about it from the government's perspective. And as of right now, it doesn't feel like it's one of those sorts of deals. It's like any sort of monopoly type move. But if you play this out a little longer term, it definitely can be. And I think the government's gotten a little smarter here after they saw what happened with Google when they bought YouTube back in the day, when Facebook bought Instagram and WhatsApp. And I think the government's starting to wake up to these things, and they're realizing, oh, these big tech companies are buying these smaller tech companies that are the next future giants, but they're getting them before they get to that giant stage, and then they, help them grow to be this giant platform, and then they almost have like a monopoly on this industry, kind of like how Meta has almost a monopoly on kind of the social media kind of industry, right? You have Snapchat as a small competitor, super small competitor. You have obviously Twitter as a super small competitor, and then TikTok. I don't know if we want to call that more of a social media, or if we want to call that more of like an entertainment platform or educational platform, or whatever you want to call it. Kind of similar to YouTube, right? Just in short form content. So very, very different. But nonetheless, Instagram and Facebook, like those are the two main social platforms, and they're both owned by the same company. So I don't know. I'll call it a 50-50 if it goes through. All I know is if Adobe goes to the 200s, I'm going to step in and I'm going to start buying that baby and throw it in the filing cabinet. Okay. Nvidia, this stock is extremely strong after earnings. Not that the earnings were great, but Jensen obviously sounded pretty optimistic. Their AI opportunity is immense. They own the chips that everybody needs for basically the future. That's the best way to put it. And he also mentioned on the conference call, and by the way, this matters for Corsair Gaming, which is a stock I own as well. He basically said that gaming is, about to turn around. That was kind of what his sentiment was. And when you listen to that conference call, is gaming's kind of, about to trend in the right way. So that matters significantly. And, this company, you look at it and it's like, it's not cheap. It's at a 48 forward PE. But when you own the company that, just has a growth in front of it for the next 10, 20 years, and you are the innovator and you are the creme de la creme when it comes to chips that the world needs, I mean, you're going to kind of command a big premium compared to the market, right? And I look at it no different than you look at something like Tesla. Tesla trades around the same forward P, around a 50. But I mean, you look at Tesla's growth and you look at where this company's going to be in 5 years from now, 10 years from now. You look what their future revenues are going to be, their future net income is going to be, the employee force they have, right? The opportunity they have, and you start to run these numbers and you're like, it looks expensive, because it's like a little over double what the market trades at on a forward P basis, but it's actually rather cheap when you start to realize that the opportunity this company has in front of it and what their net income will be in future years versus today. And so those things matter in a significant way, and that's why these sorts of companies trade at a premium. Short sellers try to short these stocks. They usually lose. It's a bad choice. If you're shorting a stock based upon valuation, it's usually a bad choice, especially if it's a great, very known company. It's usually a losing proposition. It's not really a valid point to short. You have to have other things going for yourself other than just pure valuation, because Tesla's always looked rich. It will always look rich. Amazon's always looked like an expensive stock. It always will look like an expensive stock. Shopify's always looked like an expensive stock. It always will look like an expensive stock. Nvidia has almost always looked like an expensive stock, other than like December 2018 when I was buying some shares, and that was a very cheap time period. But other than that, it's almost always looked like an expensive stock. It's actually a cheap stock. AMD for the longest time looked like a very expensive stock, but it's actually almost always a cheap stock. So you just got to understand, these companies or investor bases are a little smarter than just focusing on what's happening today. They're focusing on what's happening over the next several years. Okay, in relation to Tesla, not sure if you guys saw this. Luxury EV maker Lucid appears to have a demand problem. He plans to build just 10,000 to 14,000 vehicles in 2023. That's like nothing, right? And, I spoke about this a million times in regards to Lucid. The only thing Lucid really has going for themselves is kind of the design and the fact that the Saudis back this company financially. And so they might be able to keep it out of bankruptcy. But at the end of the day, they're blowing through all their money. They're going to likely have to do a cash raise at some point in 24, right? And maybe the Saudis step in, but I don't know who step in when it's like what is good about Lucid when they don't even have demand. That's the issue with Lucid, and I spoke about this so many times over the past year, and that's the huge risk. Is they don't really have that sort of demand. It's not like a Tesla story where there's unlimited demand forever and ever as far as that company. Lucid doesn't have that. And even if you look at, their Lucid Air versus a Model S Plaid, cheaper and a better vehicle. So why would you get the Lucid Air, right? And I've looked into it because I've always been like, well, should I get, one of those Lucids and get rid of my Plaid, or keep the Plaid and get a Lucid? And I'm just like, no, it just doesn't make sense. It would be a worse everything across the board. So at the end of the day, like, I don't know what's going to happen with this Lucid situation, but like I said, the fact that the Saudis back them, they have unlimited money. So, they could keep this company out of bankruptcy for a long, long time if they want, and they just keep plowing in billions and billions of dollars and hope Lucid eventually figures it out. But as of today, I can tell you, it's not a very exciting story. They're losing crazy amounts of money. They have almost no demand. I mean, this is like nothing for demand there. It's one of those things. It's like, why would you rather be in this stock versus Tesla? Like, Tesla's risk reward upside in potential downside so limited compared to a Lucid. Lucid could go to zero if the Saudis don't back them more, right? Versus obviously a Tesla that has no risk of that, and a Tesla that has still incredible opportunity over the next few years for share appreciation. So that's my opinion on that. No, we're in a weird stock market right now, right? You see Ericsson to lay off 8,500 workers as a part of cost-cutting plan. And it's an uncomfortable market we're in right now, right? Because you see a move like that, and that's what the market wants to see right now. And it's kind of I would call it a sucky feeling in the market, because usually it's like you see good news and all these companies are hiring and the market goes higher and it's like encouraging. It's not fun to like have to be rooting for like layoffs and employees to get cut so the market can go up. It's not a very comfortable feeling, but that's what the market wants to see right now. They want to see the economy slowing more. They want to see more recessionary fears. They want to see inflation continue to come down. They want to see all that stuff. And, it's an unfortunate market we're in right now, but it is what it is. And nonetheless, Ericsson is making that move there. Okay. Now, this shows you, I got some shocking stuff to get into now in this video now at this point in time, folks. Get ready, okay? I got some crazy stuff to show you, and this starts it right here, okay? So, by the way, I went to Dutch Bros, so Dutch Bros shareholders, give me a thumbs up, okay? Maybe I buy Dutch at some point this year. We'll see. First of many shocking things I have to show you, okay? This was from the Toll Brothers conference call. You won't see this in their press release. You have to listen to this on the conference call. This is just one of many reasons why listening to conference calls is important. You sometimes get data that you wouldn't have gotten anywhere else, okay? So, on their conference call, Doug Yearley, CEO, said their November numbers were down a shocking 72% in terms of home orders, right? Now, remember, the stock market bottomed out around mid-October into early November, right? And then the markets just started to come back throughout November, December, and obviously January was great. And so that's shocking to see how bad real estate really has gotten, right? Down 72%. Like, I honestly think that number's worse than in the great financial crisis. Like, that's like hard to even fathom. This is in unit numbers, right? Now, December, as the stock market started to come back, right? Units only down 55%. I mean, that's still a stupid high number, but 55%, right? And then January was down 31%. So it goes to show you how much Toll Brother customers are dependent upon the market, right? And when the stock market starts to do better, everybody starts to feel better. And they start to feel like, I can spend more money out there and I can go buy a new house and these sorts of things, right? Rates did tick down a little bit here, but they didn't tick down significantly. But I don't think Toll Brothers is a good gauge on the housing market. So if you're looking at these numbers and you think, oh, housing's bottomed, we're up from here, I would caution on that belief, okay? Toll Brothers is not a good company to look at, in my personal opinion, in regards to trying to gauge the housing market, unless you're trying to gauge the super high end. Here's the deal. Toll Brothers' average home they just sold, $1.1 million average. 1.1 million, okay? So in terms of Toll Brothers, that's a whole different clientele base. They're like selling to pretty much the 1%. Certainly the top 10% of the country, but even like the top 1%, okay? So you got to back it up and show all the real home builders, the Pulte Homes, the KB Homes, the Lennars, all those guys, right? And those folks are much more dependent upon, obviously, interest rates, D.R. Horton and all the others, right? And so to look at it from the perspective of thinking like Toll Brothers numbers have shown improvement, so real estate's bottomed or something like that, don't run to that conclusion. All I can tell you is the stock market matters significantly for the Toll Brothers customers. And if the stock market starts to tank again, which obviously it started here recently in February, and let's just imagine we go back down to new lows or something like that, if that was to play out, I wouldn't be surprised at all if you see Toll Brothers numbers start to come in worse and worse and worse. And next conference call, all of a sudden they're telling us that, hey man, business has gotten much weaker. Our sales numbers are going down significantly. That short-term kind of optimism we saw in January is gone now. But at the same time, if the stock market starts to heat up again, don't be surprised if the numbers get better. But that's for Toll Brothers. That's not for the housing market in general. The housing market in general is going to be much more driven around rates. And if to get a 30-year mortgage continues to approach 7% and above, I can just tell you in that sort of environment, that would create much more damage in the overall real estate market. And so don't get all optimistic just because those Toll Brothers numbers. They're in a whole different league. But I thought those were pretty telling and pretty shocking, okay? Now, I want to show you another shocking thing or two here. And this was in our weekly investor report, which I put out in the private stock group and the private wealth group. We put this report together every single week. It takes about a half an hour to go through it all. And it's just a lot of detailed information from a bunch of different fronts to keep you up to date on exactly what's going on in the economy, what's going on in the markets, everything like that. By the way, if you're looking to apply to join my private stock group, my private wealth group, that will be in the description area if you're looking to apply to join us in there, okay? The first shocking thing I want to show you here, okay? Check this out. This is from the AI investor sentiment, right? And it goes to show you how dang quickly things can turn in an epic way, from bullish to bearish and bearish to bullish, right? Look at this. Just last week, 34% of market investors were basically bullish on the market based upon the AI investor sentiment, right? Now, 21.6%. Look at that change that fast. And now we're significantly less bullish than an average market, because usually historical average, you're at 37.5% of investors are bullish. We're now down to 21.6%. That's significant, right? And now we're up to 38% bearish versus we were at 28% bearish just last week. That's how quick market sentiment starts to change, man. That's how fast it happens. And we just watched this play out, right? We just watched this play out going into the new year. All of a sudden, next thing you know, market starts going up and everybody starts feeling more bullish. And so sometimes you got to ask yourself, is it really the economic indicators? Is it inflation numbers? Is it the Fed? Does that play the biggest part in terms of sentiment? Or is it really dependent upon how much the indexes change? And the market's going down, so we're bearish. The market's going up, so we're bullish. Because sometimes it does seem like that. I'll just be completely honest in regards to these investor sentiment type surveys. But that's incredible, folks. That's shocking. That big of a change? We're talking, that's like almost 13 percentage point change. That's insane. That's one of the biggest shifts I've seen in a week-to-week basis, and I track this almost every single week. That's one of the biggest moves I've seen. One of the biggest moves I've seen that quick. And look at where we're just at. The 1 year bullish high was just, a couple of weeks ago. Obviously, today's the 24th. This was on 2.8, folks. We were at the average high, 37.5%. And look at how fast that happens. From February 8th to now, today's February 24th, from 37.5% bullish to now 21.6%. Like about a 16 percentage point difference in a matter of a couple of weeks. Insanity, man. It shows how fast investors can flip on the market, okay? Next thing I want to show you, this is shocking. This is something shocking. We basically post up the top stocks in different indexes and things like that. One of those is S&P 500. Who would have ever thought in their wildest dreams that the leading stock this year for the S&P 500 would be Warner Brothers Discovery? This stock has an almost 66% gain year to date. That's incredible. I do know a few people in the private stock group that do own this stock, and congrats to you guys. Oh my gosh. But that's shocking. I mean, to see that be the best, it's not like it's impossible to imagine it gets a good return rate, but to see it be the best stock year to date, beating out Tesla, beating out Nvidia, oh my gosh, beating out Align Technology, beating out Meta, it gets incredible, right? And it goes to show you can find investment opportunities out there that sometimes aren't the most popular stocks, right? And if we look at my best stock in the public count in terms of percentage gain, it's Elf Beauty at a 907% return, right? That's absolutely incredible. It's my best stock. It beats out Tesla. It beats out Revolve, an e-commerce company, right? Beats out a semiconductor company. It beats out Meta. It beats out everything in terms of percentage gain, 907%. For a cosmetics company, a beauty company. It goes to show you can find gems in the market all over the place. There's always great opportunities out there, and sometimes it might come from a cosmetics company, sometimes it might come from, EV company, sometimes it might come from Warner Brothers Discovery. Like, you never really know. It's just where you can find those opportunities in the market, folks. And that's why it pays to research, build out great diversified portfolios over time, folks. Hope you enjoyed today's video. As always, thank you everybody joining me. Patreon squad, don't forget to check out the moves I made in there. And also, if you're looking to join us in there, it is a no-brainer to see the stocks I'm buying and selling, exactly how I build out a portfolio step by step. Check us out in the description area down there to join us in the Patreon. Much love and have a great day.